Welcome back, everyone, to another episode of the Mastermind Table podcast. Today, we got a special guest, my buddy Austin Schneller with Lifetime Financial Group. He is a financial, and he's my personal financial advisor as well. So, Austin, really appreciate you taking time to stop on here and give us some information about your financial advising and what you can do and kind of the things that you're seeing in your market.
Yeah, thanks for having me. Excited to be on here. Really enjoy what I do and like to share what I do with as many people as possible. Obviously, been a pleasure working with you over the last year and getting to know you and seeing you grow in your business.
Yeah, absolutely. So we won't waste any more time. We'll jump straight into it. So, Austin, can you speak a little bit of your background, your expertise, your company, how you kind of got into it?
Yeah, absolutely. I'm from Bowling Green originally. Went to Western Kentucky University. Graduated with a degree in accounting and finance. Really, all of my experience throughout college was in accounting. Worked with a Big Four firm in the audit space. Did some private tax, filing tax returns, and really throughout college, my focus was in accounting. Um, I realized that wasn't the passion that I had. It's not what I wanted to do on a day-to-day basis. I wanted to be in front of people. I wanted to really see results play out, not only for myself but for people that I worked with, and landed on working with Lifetime Financial Growth. Um, right out of college. So I've been with this firm for a little over 3 years now. Um, our firm is one of the largest privately held wealth management firms in the country. Really one of the largest in the Midwest. So um, we are in 6 states here in the Midwest and have just opened up our seventh state in Florida. Um, but our firm really takes a unique approach to financial planning and really take a macroeconomic approach to how we do things, really looking at a big picture for our clients of, what decisions do they make um, that have an impact on their balance sheet. And a lot of that ties into having conversations in areas that advisors typically don't. So we have a lot of conversations around how they manage their debt, how they manage the real estate that they buy, really taking a deep dive into conversations that, rely on us connecting with other professionals here in the area to have their expertise for our clients. So have really enjoyed the 3 years that I've been with the firm, and have a passion for really seeing people achieve their goals, whether those be short or medium term. We just want to make sure our clients are doing the right things now so that those goals take place sooner rather than later.
Right, 100%. And when you're going through that and you're meeting with all your clients and you hear somebody who says that, my goal in the next 2 to 3 years is to purchase my primary residence or just purchase real estate in general, what kind of general advice do you give to those clients to set them up for success?
Yeah, I think a great place to start for people that are looking to buy a home, especially for the first time, is looking at the budget. How much money are they saving? Where is that money being saved? Um, Obviously, the interest rate market is something that you or I have no control over. But one of the things we want to make sure people are doing is saving a certain percentage of their income. So we like our clients to be what's called a world-class saver. So that's saving anywhere between 15 to 20% of their gross income. Now, where the conversations start to be a little bit more impactful is where that money is being saved. Liquidity is king when you talk about buying a home. Having at least 3% to put down for that conventional FHA loan is super, super important. The 20% down rule is something that I think everyone thinks is what has to happen. But obviously, working with you all and mortgage lenders here in the area, that's not the case. So when people are trying to get into a home sooner rather than later, making sure that they're building some source of liquidity outside of their retirement planning is super, super, super important. And we want to make sure people understand the impact that liquidity has in making that decision to buy a home.
100%. Yeah, definitely. I definitely agree with that. And is there any mistakes that you see people make that you would recommend to your clients to like avoid when it comes to that? Maybe it's they're trying to buy something too early or
Yeah, yeah, I would say that one of the key mistakes that we see is um, the intentionality of money. Um, if someone's main goal is to buy a home in the next 3 years and 10% of their income is going into their 401k, those don't really align well. Inside of a 401k and a Roth IRA, you're allowed a first-time home buyer withdrawal with no penalty on either. Obviously, tax in the 401k, but a first-time home buyer withdrawal of $10,000. Um, but if someone's putting 10% of their income in a tax deferred vehicle, it's really geared just for retirement. They're not really matching their intentions with what their goal is. So really taking a look at that budget again and making sure that we're building liquidity to accomplish what they want to accomplish is super important. And obviously, we see an impact of the more money that's put down on buying a home. Typically, the smaller they're going to have in a monthly mortgage payment, which in my mind, monthly cash flow is something that we want to capture the most of, and it's going to set them up for the long-term benefit in retirement planning and building liquidity is having a higher monthly amount of residual income, and a lot of times that can be impacted by how much money's put down on that purchase price.
So, at what point would you consider or look at somebody's foundational financial foundation and look at them and say that you're ready to take that next step and possibly buy a house or to move forward with investments? What would you say is that base level that you're looking for?
Yeah, so I think it's very, very different for each client. Where do they want to live? What's the purchase price of the home that they're really looking for? But we really like to see clients have anywhere between $10,000 to $20,000 liquid to really start making decisions in that space. An emergency fund is something that we coach on quite often. We don't want them to buy a home and completely drain what their liquidity looks like. Obviously, you've seen stories of people having to replace HVAC units in the first 12 months of living in a home, have a claim on their roof in the first 12 months in a home. We don't want people to rush into doing things like buying a home if they're not going to have some source of liquidity after making that decision. Life happens. We want to make sure that liquidity is there even after buying the home. So tough question because it really is contingent upon their specific scenario and what house they're looking to buy. But the main general advice that we give is we want to make sure that they at least have 3 months of income liquid even after the purchase of their home.
I gotcha. Yeah, and a lot of times when I speak with clients, their biggest asset in their family or in their life is their home that they purchased. And so I think that real estate is a phenomenal way to build a retirement plan and to build your portfolio, but I also believe in diversifying your income because you don't want to have 100% of your assets just in real estate. You want to spread it out. So what other retirement vehicles would you also recommend outside of just real estate?
Yeah, absolutely. I think taking the match in the company 401k is absolutely important. Obviously, you have to look at the vesting schedule within your company to make sure it's suitable as far as your intentions of how long you're going to work there. But taking the match, it's free money. Absolutely. Some companies offer Roth 401ks, which is really paying the tax on the income and then having the tax-free growth inside of it. Roth IRAs, very similar to the Roth 401k, just outside of the company. It's really the only vehicle that the government has allowed to have tax-free capital gains inside of the stock market. So we really, really want to make sure as people are looking at where to save money outside of the 401k that they have some portion of their income being saved into that vehicle, income allowing as far as, if you make too much money, you're not allowed to contribute to it. There's a maximum amount on an annual basis that you're allowed to contribute to that, but also in the non-qualified space. So anything outside of a traditional retirement account like a Roth IRA, a traditional IRA, or a 401k, as I've said, liquidity is king. We want people to have liquidity not only for emergencies, but when investment opportunities present themselves. If the housing market were to really take a dip and people are intentional about being real estate investors, having cash parked on the sidelines in non-retirement vehicles is super, super important so that they can take advantage of those opportunities. Same with the stock market. We look at a year like 2008 where equities drop in the realm of 30 to 40%. That's a great time to buy equities. You're buying them on a major discount. The same for 2022. The market drops in the realm of 15 to 20% in the S&P 500. Having cash on the sidelines and buying equities at a low point, you see a dramatic increase in your overall return, even in just the 2-year period that we're looking at now from September of 22 to September of 24. So obviously, as you said, real estate's a great place to look at when building a foundation for retirement. But we want people to have a good spread of assets that they can lean on as they're nearing retirement, and we want to have some non-qualified investment assets in that conversation as well.
Yeah. Again, diversity is key. Now, you don't want to be too diverse where you don't have any money or anything like that in any assets, but you definitely need to have some diversity in it. And obviously, I think we both can have an agreement on is whatever you know the best is where you need to have most of your money at. And so when you're consulting with all these clients and you're talking to them, reviewing their situation, what are some of the common mistakes that you say that you would see that doesn't help somebody's financial situation or may set them back that you recommend to try to avoid?
Yeah, I would say the first place would be, once again, the 401k, intentionality with money. Taking the match is absolutely great. But looking at the excess that people put in above the match at a young age really is locking up money for a long period of time when the liquidity could be more beneficial for them. There's more liquidity. What's the word I'm looking for? There's more liquidity inside the 401k and more options available to them. More in the Roth IRA than the 401k. So we want to make sure we educate our clients on, what are the tax implications for accessing money in each vehicle that they choose to save in. So just educating them on where they should be saving money. We see a mistake that too much money is going into the 401k and they don't understand the long-term impact from a liquidity standpoint there. The benefits package is somewhere else where we focus a lot on. We spend a lot of time educating our clients what's available to them inside their benefits package. A lot of the mistakes that we see is that people aren't opting into some things in their benefits package that are super, super important, or they don't have things in their benefits package offered through their company that they should be looking to acquire outside. One of those things would be, income protection, long-term disability insurance. That's something that we want to make sure our clients have in place in some way, shape, or form. Some employers offer it, some employers don't. We want to make sure that they understand the language inside those contracts if they do have it through work, or help them look at acquiring that outside of their benefits if they don't have it. Income is really the fuel to any financial plan. It's the fuel that keeps the engine running. We want to make sure that asset of unearned income is first of all protected, but also being saved at a high level. The average savings rate right now in the U.S. is roughly 4% of gross annual income. I think a lot of that has to do with inflation. We take our first-hand responsibility in making sure we have our clients on a path to get to 15 to 20% of saving their annual income. That is not a marathon. It doesn't happen overnight. It's not a sprint. It's a marathon, is what I meant to say. We want to make sure that we're getting them on the path to saving 15 to 20% of their income. And a lot of that comes down to budgeting and having tough conversations with people to make sure that they're really tracking where their money's going on their balance sheet.
There you go. And I got a few questions for you for different ages. So what we'll do is I want you to give some advice, like just financial advice for anybody at a few different ages. So we'll do 18, fresh out of high school. What's your financial advice? We'll do 30 years old. What's your financial advice? At 45 years old and at 60 years old. And Austin, if you had to give some financial advice to an 18-year-old who just graduated high school, what would you say?
Yeah, I would say that, if you're going to college, coming out of high school, going into college, whether you're a finance major or a business major or not, make sure to take a financial literacy course. I think building the right habits starts at a super super young age when it comes to handling your own finances. So just educate yourself. Um, you know, really try to make sure that you're putting your best foot forward on habits when it comes to saving money. Educating yourself on the investment world is also super beneficial. Um, but I think just building habits at a young age is the biggest piece of advice that I can give to someone that's coming out of high school. Just making sure that if there is income that's being reported, that you're trying to save as much of that as possible. Obviously, lots of fun in college. A lot of money can be spent doing fun things, but building those habits at a young age is something that we strive to have. The children of some of our clients do at a young age.
Okay. And now that you graduated college, you've been in the workforce for a little bit now, turning 30 years old. Maybe you're starting to have kids at this point, or maybe you have young kids. Maybe you be looking to purchase your first house. At that point, you're a lot more established. What would you say to those people?
Yeah, I would say that having just that macroeconomic level review of the plan is super important for a young family. Making sure the proper protections in place. Term insurance for a young family is super important. Making sure that the income protection's there through work. For someone that is around the age of 30, we like to see liquid assets approaching one times their income. So if someone's making $100,000 at the age of 32, we want to make sure that outside of retirement vehicles, savings, non-qualified investment vehicles, we want to make sure that liquidity is approaching $100,000 one times their income, and that they're saving 15 to 20% of their income as well. I think that's the biggest thing. You see a lot of income increases take place in the range of age 30 to 40. If you have the right habits in place at the age of 30, it's going to be a lot easier to continue those as the income increases in that 10-year period from 30 to 40.
Okay. And then could you explain real quick for the listeners that don't know what a non-qualified vehicle is?
Yeah, so a non-qualified vehicle, I guess I should start with a qualified vehicle. Qualified vehicle is going to be a traditional retirement account. So a tax-deferred vehicle or a vehicle that should not be touched till 59 and a half. So that's going to be your Roth IRA, your traditional IRA, your 401k. Those are your traditional retirement accounts that most people tend to use. Not the greatest place to turn to when liquidity is needed. For example, to buy a piece of investment real estate. That's not where people typically pull from. We want to see people have money in non-qualified vehicles, so that being a brokerage account, that could be a TD Ameritrade, a Robinhood account, an account with our firm. That could be a high yield savings account through your local bank. That could be a money market fund that you've bought through a brokerage account like Robinhood, for example, or just your plain Jane checking account, right? Those are our non-qualified assets. We want clients to have liquidity there for emergencies, but also for investment opportunities. Kids are expensive. Life happens. Medical concerns take place. We don't want to have a situation where clients are turning to use a credit card to fund major expenses because the interest rate on credit card debt is so high that there's really no return that can come close to it. So we want to make sure that we have the liquidity so that decision never has to take place.
100%. And going back to the question structure, if they are 45 years old at this point, maybe your kids are older, maybe they're teenagers, or they're just now starting to head out of the house and it's maybe college time for the kids, or whatever it may be at that point. You've been in the workforce for maybe about 20, 25 years at this point. What would you say to those people as retirement's maybe 15, 20 years away?
Yeah, I think leading up until that age, making sure you're doing some college planning for the kids. That can be in a couple of different college funding vehicles. 529 plan is the most common, to name that. Making sure that we've had that conversation with the client, that they're aware of what's available to them to fund college education for their kids. The biggest thing for someone that's 45, kind of creeping closer to retirement, more so than someone that's at the age of 30, looking at their asset allocation. I think that a lot of people when they invest money, the main advice is to invest in the S&P 500, or if you're looking at someone's 401k account, they're typically invested in a target fund um, that is offered through their employer's 401k. We want to make sure at that age that they're getting the diversification um, that is available to them to provide the highest level of return with the lowest level of risk. What we find is that a lot of people are just, going through the motions and buying um, funds or ETFs that really are U.S. equities tilted towards the S&P 500. It's not to say that they're going to end up in a bad spot making those decisions, but for our clients, it's about making sure that they end up in the best situation. And a lot of times that takes place when we look at asset allocation and diversifying outside of just U.S. equities, but looking at some small cap stocks, some international equities, and really taking a deep dive and educating them around what risk looks like in their portfolio if that matches their risk tolerance, but also getting that diversity in some other asset classes outside of just the standard S&P 500 that we typically see clients invested in.
Okay, awesome. And then as we're getting closer to retirement, we're now 60 years old. You may have older kids who maybe are now out on their own. Retirement, you may be looking at within the next 5 to 10 years or so. And at this point, I know we've had conversations. It's time to reduce your risk level at this point because you're going to probably start withdrawing from your Roth IRA, from your 401k, whatever it is. What would you say to those people that are ready to retire?
Yeah, once again, it's a conversation of when are they looking to retire, what's their desired level of retirement income, how have they done up until this point, what do current asset levels look like. But the biggest thing, as you mentioned, is what should the risk exposure be in the portfolio, and that really determines that's really determined based on the things that I've mentioned. What's the retirement income that's desired, how long are they away from retirement. Some people want to retire at 60, some people don't retire till they're 70. um, it tilts a lot to those questions. But the biggest thing is really making sure that they understand what's available to them in the retirement income space. There's so many different strategies that you can use when looking at retirement income. Annuities are very, very popular in that space. It's something that mirrors the idea of a pension. The baby boomer generation was the first generation that retired without the pension program for the most part, and the 401k became that main vehicle that replaced the pension. So we want to make sure that people have at least a certain level of guaranteed income outside of Social Security that's built into their plan. So we really look at that annuity space and talk to them about the options that are available to them, not only to have guaranteed income in the portfolio, but also to take risk off of the table in the retirement investment space. If we have 20% of the desired income in retirement that's guaranteed, the other 80% that we're drawing off of in the investment space, we've ultimately reduced the risk of those assets by taking pressure off of them by having 20% of that income already guaranteed in the form of an annuity.
Awesome, man. Awesome. And one last question for you, and then we can wrap this up. I see all over social media the concept of infinite banking with life insurance, and I get a lot of questions from it. I get a lot of people bringing it up to me. So what is your opinion, and can you explain how infinite banking and the concept and how all that works?
Yeah, it's a complex one for sure. Very complex. I think there's a lot of misinformation out there on it. Um, Lots of different types of life insurance, but we'll talk about just a very, very simple one today. Traditional whole life insurance. Um, it's not for everyone, without a doubt. It takes time to build liquidity inside of that vehicle. But when looking at using it from a banking standpoint, um, we're in a market right now where interest rates are in the 6 to 7 to 8 space when looking at loaning money from a bank. Um, the idea of using life insurance to be your own bank, you're really taking a loan against the cash value. everyone has a misconception that you're loaning against a death benefit. It's not true. If I went and bought $1 million of life insurance, I can't take a loan for $1 million because that's the death benefit. We're loaning against the cash inside the contract. The advantage of loaning against the cash in the contract, obviously it takes time to build that liquidity. But for example, insurance companies set cap rates at which you can loan the money out. For example, one of the insurance contracts that I've seen that was done in 2021, the cap rate is 4.65%. So you're loaning the money out at 4.65%. You are your own bank. You set the terms as far as when you pay back that loan, rather than the bank telling you when you pay back that loan. So if, for example, I loaned out $10,000 at 4.65%, I can just pay back the interest for the next 3 years and then decide I'm going to lump sum it all back in. I really set those own terms for myself. Also, we're at a lower interest rate with that cap rate than what's available in the market from banks and mortgage lenders. So you're not beholden to the interest rate market outside of the insurance contract. And then last but not least, we have a guaranteed growth concept inside of that insurance contract. We are seeing growth regardless of what takes place in the bond market. We're seeing growth regardless of what takes place in the equities market. So all the while, we have an interest rate being loaned out at 4.65%. Depending on the year of the contract, we're seeing in the realm of 2 to 4% being paid back in the form of a dividend from the insurance company, effectively lowering our interest rate on the insurance contract, to 1, sometimes less than 1%. So it's not for everyone. It takes time to build liquidity inside of those contracts. But when we talk about diversity and being able to use money in a liquid sense, it's a great vehicle to use long term, to really be your own bank and not be beholden to the loan repayment schedules of banks, and to not be beholden to interest rates in a high interest rate market like we're in today.
Awesome. Well, Austin, man, we definitely appreciate you coming and dropping all this game on us and introducing us to a bunch of different concepts and sharing your expertise with us. If anybody's interested in meeting with Austin and want to talk with him about their financial situation and see if they'd be a good fit, Austin, what's the best way to get in touch with you?
Yeah, email's fine. Phone number's fine as well. Here local in the Louisville area, but from Bowling Green, so do a lot of work down there, a lot of work in Nashville. But Ramir has my contact info. I'm sure he'll drop it somewhere on this post or wherever that ends up. But yeah, feel free to call me or shoot me an email. Would love to just educate people. Really like seeing people achieve what they want to accomplish, and I think there's a lot of hesitancy from people to meet with advisors. But really, our job isn't to make clients day one. It's to earn trust and make sure people understand who we are as a firm and to help them get organized. So would love the opportunity to help anyone that I can.
Thank you. Well, thank you all for tuning in to another episode of the Mastermind Table podcast. Wish you best of luck, and go be great.